Shifting from short to long, Gary Glover has been riding the short wave for months. It's time to take profits and talk about where to deploy the funds now. Good morning, Gary. This should be a fun report to cover.
Yeah, we're sort of into the meaty part of the bear market now, so we're approaching the end of it, I think.
Well, looking at your reports for months now, we're edging closer to those profit targets that are on your shorts, and you've slowly been buying some shares for the portfolios or looking for the levels. Are you starting to look for opportunities at the big end of town, or where are you focusing that lens?
Yeah, no, so generally sort of, I think the market sort of goes through the three tiers there, really. So in the early stages of a recovery, market looks for safety. There goes, I think market heads towards the leaders, the safer end of the market. And then once I start getting a bit more confidence, I'll return sort of back to those sort of mid-tier sort of mid-cap sort of stocks there. There's probably a bit more growth in there. And then once you're sort of in a full-scale bull market, then everyone gets more confident with the small caps. So first place, people look to go is the value sort of, the top tier. So you're looking at your sort of top 50 sort of stocks there. So that's probably, that's generally the sort of safest end there. So resources haven't come off too much, but definitely the financials and some of the other industrials have come off. So there's definitely some value in there.
Okay, well, we'll have a look at the list that you've brought forward in this week's report in a minute, but we'll start with the fastest faller. So the NASDAQ, that's given you the greatest profits in this bear movement. And we've covered the spacing in the last 2 weeks of reports. So if anyone wants to look at that spacing that you've got here on the chart in detail, they can have a look at the last couple of weeks. But now we're coming into these target zones, and these are the red circles on here. So how have you calculated those? And now that we're coming into them, what's your action now that we're kind of coming into that target zone?
Yeah, so two things. They're obviously looking to sort of start to scale out of our SNAS and BBOS. So I generally just don't like to exit all in one fell swoop. So I'll just sort of stagger my entries. Just that way, it's sort of sometimes you might be getting out a little bit early, or if it bounces with it, you miss some, or so I just find it's better to like scaling in and scaling out. I just find that a little bit less risk averse, and then that way you're locking a bit of profit in. If it does sort of happen to bounce, then at least you've sort of locked in some good profits. If it does continue to go down and hit your targets, then you can, if you do scale out, then you can still sort of get hopefully the last parcel done at the peak there if you nail it. But it's a game of percentages, the trading, and it doesn't always sort of go perfectly to plan. I'm a big believer sometimes if you sort of get to 80% of your target, that's probably good enough. And that's when you should sort of start taking there. Because I mean, it's just, if you study Bulkowski and percentages and stuff there, the targets and stuff there, doesn't, you don't always get 100% of your target reached. So sometimes it might go 80 or 85 or 90%. So we should just sort of starting to scale here. So should be starting to scale out of our shorts. And at the same time, we should be starting to sort of scale sort of into some longs as well here. So that's what I'm looking at doing here, really. It's just sort of here, starting to sort of scale out, give myself some targets on the SNAS and BBOS, and then starting to scale in, so looking for some stocks here. Probably looking at sort of some of the top tier, top 20, top 50 sort of stocks here first. And then we'll look later on in terms of a bit more growth there. But yeah, so far so good. It's sort of, we're almost, we're getting pretty close to some of those targets. So within sort of touching distance. So the key thing there is to sort of get planned, get your targets in there, and then get your long target sort of set as well. And then even if maybe you tier your orders as well. So you might be buying near your low and then at your low, and selling out of your shorts sort of near your low and at your low. So therefore, you're sort of getting a little bit done as well, just in case it doesn't go perfectly to plan.
Okay, well that's a good process to wind out of the shorts, load up the long positions, and make that transition, as you've talked about, changing of character and markets and that kind of thing.
Now, it's probably still a bit further to go here, Chris, because obviously we sort of feel like we haven't capitulated into that low. That still got the timing is getting pretty close here. Everyone's sort of probably starting to turn a little bearish as well, so which is always a good sign that no one was bearish at the top, but everyone should be really bearish at the bottom. That's sort of yeah, complacency at the highs, and then fear and you know, fear at the lows and stuff. There, like basically everyone should be scared to buy, and that's usually the right time to buy. So we want to see everyone get a little bit more scared here, and that's that'll probably be the right time to be sort of adding here. But I think, you know, our market's off 16%, Chris, which is a pretty big correction there. I think, I mean, through 2002, our market only fell like less than 15% over that bearish period. So this is a fairly sizable correction for the Aussie market. So yeah, I mean, maybe I was only looking for us to sort of get down towards 6,600 or something. Would have been, you know, somewhere around 66 or 65.50 would have been a good target for us. But yeah, we've gone probably slightly beyond that. So maybe we'll go and touch the bottom of that channel, or maybe there's a few levels there, maybe 6,300 or something like that. So we're approaching a few sort of key levels for mind here. So just, you know, I think we should be starting to venture in, particularly the Aussie stocks there. Probably I wouldn't be buying US stocks. I wouldn't be buying US funds here, but I would definitely be buying Aussie sort of value type, you know, blue chip sort of top 50 type base funds here at the moment, particularly sort of high yielding ones.
That's a good point to look at your chart that you've got here. It's a rather busy chart on the Aussie, and you're looking at here, you've got 11.4% drop in 5 months. You've written down 16% so far where we are. This is reports obviously done over the weekend.
Yeah.
Now, that's coming to that channel, which we can see those two parallel red lines. Then to the right-hand side, we've got some red numbers and some blue numbers. So are they the Fibonacci levels of what, the rallies and retracements, or where have you got these percentage ranges?
Yeah, so I've just got a few ranges there, a few expanded ranges. I've got some old ranges and some current ranges as well. So yeah, sometimes there's a bit of a cluster there. So there is actually a big cluster there around that sort of 6,000 mark. I don't see it overshooting there, but there's definitely a few levels around here to watch. I'm usually looking at the timing as well. So, you know, if we're around 6,300 there around here in the next week or two would be that'd be pretty nice. Kind of low there. Yeah. So around there, look, maybe we overshoot it. Maybe we come back near that range there. Kind of hard to see it myself here, but I feel like we're getting. But you never know. The US market's still on a bit of a strong decline here. Still hasn't sort of shown too much strength on the rallies here yet. So, you know, definitely, our market's got a history of overshooting. So, lots of what do you call it, long tails on the All Ords and XJOs over the years. So, yeah, but we'll see. I think we're definitely getting pretty close here. So we should be starting to venture in, I think.
That's a good point, because as you say, we're only sort of 100 odd points away from that range. It could go a bit further, could overshoot, and hey, 6,000 is also a level, but and in that sort of range works out with the timing. This is probably a good point to move over to the blue chips that you've mentioned, because you're talking top 20, you're talking value stocks, maybe top 50. We can't go past the Commonwealth Bank on the Australian market. It is such a heavyweight, and it's been hit hard. The yield has increased, so it's somewhat attractive now. What does it look like to you now that we've fallen through that $90 a share level?
Excuse me. Yeah. So just looking for a few different levels and stuff there. So I thought the old high, that's probably the first sort of support I was looking for. So we've sort of overshot that, and we've also shot the 61.82 just on our sort of ranges there. So just, you know, maybe we'll come back towards 50% there. Looks, sometimes they don't always get there. Just a few levels to sort of be mindful there, but I think we're sort of, you know, definitely in terms of sort of where the stock traded historically, we're sort of now back to what I consider to be more normal valuation. Always felt, you know, I think at 108 they were trading on 21 times for Combank, which is just, you know, pardon the phrase, but it's pretty outrageous multiple for this bank here. Probably, you know, market's paying a little bit of over safety there at the time there. So, you know, now we're back to what 17, 18 times there. We're sort of back to sort of, you know, more normal multiples here. So, yeah, no reason why it can't come back to, you know, $81.50, $82 there. That's probably going to put it down the maybe 15, 16 times, which is probably pretty attractive multiple there. So I'd be, you know, more than happy to be buying anywhere near there. So look, it may not get there pretty heavy volume on the way down here, so a bit almost a little bit exhaustive that sort of last week. So you might it might cool for a week or two. Maybe it goes back and retests that that sort of $91 level, and then maybe it sort of comes back down here. But yeah, look, I think we're definitely getting back to some value points here. So I think market's sort of got a history of sort of coming back into these sort of top tiers. So yeah, I think anything sort of down there $82, I think I'd be buying in here. I think that's going to put a good multiple, good yield. I think that's the place to be sitting here. So if we are in a sort of inflationary environment, then it's going to remain elevated. And if we're going to be like a low growth period, like a 40s or sort of 70s style market, I'm not that negative, but if it is that negative, then these sort of the value stocks, the high yielding quality industrials, that they tend to outperform in that period. So I'm not that bearish. I think actually we can bounce back here. I think everyone's panicking recession too quickly here. I think I just think there's too many jobs there. I mean, you walk around. I'm in Melbourne at the moment. Every cafe, every restaurant, every bar, it's got a sign on the door looking for work, looking for workers. I mean, I know costs have gone up, inflation's gone up here, but I still think the economy is pretty healthy. I think once crypto is going to make a few of the younger generations a little bit less wealthy, that interest rates going higher is going to make people a little bit less wealthy. But there's jobs out there, so we can all go and get a second job or work an extra shift here. There's plenty of work around, so I think we can make up that extra cost there. So I still think the economy's a lot, maybe a little stronger than everyone's thinking here. So I think the market will bounce back a lot stronger than everyone thinks. But if it's as dire as everyone's thinking there, then still being in those sort of value, high yielding sort of quality industrials is still the place to be. So so whichever way you look at it, you got to look at the top sort of quality sort of companies. Look for lower PE, sort of high yielding value stocks is the way to go.
Well, if it is an extension of the markets, the economy's not as bad. Anecdotally, you're saying Melbourne, there's still plenty of jobs. In Sydney, I was just talking to restaurant and cafe owners in the Bondi area. They shut 3 days a week because they can't get the staff, and they're losing staff, wait staff at $80 an hour, which is, I don't know about you, but $80 an hour goes pretty well, and that says the economy's running. Plenty of jobs out there.
There are, So if look, if there wasn't as many jobs around, or if the job market had softened there, then I'd be concerned about the economy. But I still think, just COVID's probably made a little bit, everyone too comfortable, and obviously, we've obviously lost a lot of overseas students and travellers and stuff there. So they, it'll take a little while to come back here, but. With some of those negatives, I think they can be made up pretty easily. People can go and get a second job here, go and get some more income there. There's plenty of work around. So I just can't get too negative there. The economy there. So I think got to be looking to buy these dips here. Midterm years just renowned for having these really deep sell-offs and then having pretty strong bounces. So just got to I think if we see a bit more of an aggressive sell-off here, I can see a pretty strong bounce following as well.
Well, that could bounce for Commonwealth Bank, and also ANZ's another bank that you've picked up. Now, on the chart here, you've got the 0, 1, 2, 3, 4, 5, these consecutive higher lows. You've covered that just a couple of weeks ago in more detail as to how that works and what the behaviour is of the company.
Yeah.
This has been a solid drop-off here. So obviously another blue chip company, another top 20. These buy zones, would you also be looking at options in this kind of part of the market?
Oh, look, at this stage here, obviously, in the early stages, that sort of drop there, I was probably looking at, maybe selling some of the volatility into some of those better name stocks here. But now we should be looking at positioning for the bounce here. So trying to sort of, if we can jag the sort of low here or buy on this sort of aggressive dip here. I think ANZ's now back to PE of 9, the yield's around 6.5%. So, even if you do a little bit of shaving off of earnings there, still pretty low multiples. So they're sort of almost GFC sort of style numbers there. Maybe not quite as low, but getting in terms of historics, getting to some pretty decent sort of multiples there. So it's definitely some value here. So yeah, so the ANZ has been definitely one that's led the way here, probably overshot here, probably currently most unloved. Yeah, I know Westpac's a bit unloved as well, but this one has really had probably the largest correction of the move here so far. So yeah, again, I think maybe if we've overshot the 50% mark, I think if we came down to that 2010 zone there, $20 zone there, that'd be super. Yeah, super. So to me, I sort of get your buy orders sort of ready. If we get sort of levels down there, I'll be sort of adding in here. Might be using some options to sort of maybe get a similar style entry here, but yeah, it's definitely some value down here, I think.
Nice. Well, that's another bank. And then going to a different style of bank, Macquarie has different exposures, definitely positioned itself to be more international nowadays. So you're looking for similar sort of support region here on the index. It's sort of overshot those 2020 highs pre-COVID. Is that red line looking to be a buy zone for you?
Yeah, so looking around, I just think this one's been pretty strong here. It's been a bit of a pretty well loved. It's obviously been pretty strong report as well. So, I don't think it'll get down to 144. I mean, that would be pretty awesome if we get down there. But I think I'm looking at the old high. There's been just a lot of stocks have bounced off the old high here recently. So that's probably the zone I'm looking at there. So that's probably, it's probably going to be good enough there. So, if we buy a little bit there, maybe if we get to 144, we buy the rest. But, I don't, may not get down there. Chris, it's sort of one of the probably strongest performing stocks here. So, I think that's come back a reasonable amount there. So, I say that commodities sort of stay reasonably robust. So we were just talking earlier about the 70s, those sort of low growth markets there, high inflationary environments there. I mean, energy and precious metals market was pretty firm throughout the whole period. So they had it's definitely some big years up and then some big years down. But over the decade, it was still a fairly robust period. So, Macquarie and some of the other banks have done pretty well. Trading side with commodities there. So I think that that side will have its ups and downs here, but I still think it remained fairly robust throughout for a while here now. So I just I think that still looks pretty solid.
Well, to move from the banks to a different area of the market, which may seem odd in this current environment, we're looking at the resilience of travel and reopen and tourism companies that have fared well, relatively well in the last couple of weeks and months. But we've got a high price of oil, rising interest rates, which normally curb the discretionary spending. But Flight Centre's still catching your eye. So how's this COVID period and Flight Centre's chart making it different for you now?
Yeah, look, bit of a favourite for me. I've sort of been in and out of this one a few times here now. So been buying stocks, sort of writing calls on the high end, even selling puts on the low end, and buying some more on the pullbacks here. So I just really like this stock here. I just think, if we look at our long-term valuation, sort of market cap there, we should be looking at $24, $25 there eventually. That's probably equivalent to the old sort of, I think, 44 sort of valuations there, based on the number of new shares issued there. So I just think over time here, travel sector will recover. I think just anecdotally you're already seeing sort of some pretty strong numbers come through travel wise. So I know it takes time here, but market looks forward, and so I think this looks quite good. I mean, Flight Centre, I think, and New Zealand, I think even some of we saw corporate travel bounce pretty strongly. So I think this is a pretty good sector to be looking at. Any weakness there? So I mean, technically we come back down the bottom of the range there. Basically hit it right on the dot almost. So I've managed to sort of get a nice parcel there on that pullback there. So I think anything sort of anything under 17, I think is probably good value there for mine. So do like this one.
That's one you definitely have traded well in the last couple of months and years. Now, if we go to another space, Sonic Healthcare, this is rather defensive. Is that attractive at this part of the rally when you're looking at top 50, top 200, top 20, top 50, I should say, and blue chip companies?
Yeah, it's one of those sectors there. I think it's, apart from sort of coming back to some, pretty good value point here, I still think this is a sector that, like the travel recovering here, I think healthcare has had a tough, couple of years. I know some of them have made some money because of the COVID situation there. But the normal operations have been very disruptive. So, no surprise to see that Ramsay sort of get bid for, even though that wasn't, I wouldn't say it's a real bid or but it's pushed its price up there. But stocks like Sonic Healthcare, even Healius as well, HLS, I'd be probably looking at that. So I just think this is a sector where we can see some growth there. I sort of think healthcare and possibly biotech might be the next leadership group to emerge from this after this bear market's done here. So already starting to see a few of those biotechs hold up pretty well and seen a bit of buying come in. So healthcare as well here. I just think, so this is a sector I'm really, really interested in. I just think around that sort of 32 is sort of the old high that's held so far. The fact that we sort of come back pretty quickly and retested that tells me maybe we go slightly lower here, but it might not as well. So, I'd probably be tempted maybe to look at a little starting parcel here, and then look if it got down to that 30-40 zone there, then I'd be topping up here. But it probably won't come. I don't think it'll come back too much further than that. So I definitely think there's some value here. I just think there's a sector I want to be in, want to be long here longer term. I just think it's going to be a pretty robust sector there. So it's going to be like a lot of backlog. Obviously elective surgery sort of stuff there for Healius and for Ramsay, but for Sonic and stuff, that'll just be like all the normal scans. Once we're all up and about again, normal sort of medical sort of operations will return there, and we'll be getting more normal sort of scans for normal injuries. Flagship. Our age, Chris, we're still trying to stay young and active, and
the bodies are fighting us.
Always get hurt. So we're at the doctor every few months. They're getting a scan for something because we pushed ourselves too hard. But it's still a great segment here. So aging economy as well in Australia. So none of us really want to age. We sort of
no, we're not giving it up yet.
No, that's right. So it's just going to be a great solid business. It's a good quality company. So just there's lots of reasons to like it, really, in my opinion.
Nice. Well, that's a good couple of companies to look at the top end of town on the ASX. And as you're saying, the market still may have some fall, but it's really the time to know where your buys are, which companies you're comfortable holding, where those buy levels are, because is it still a situation where it may get hit hard, like you said, in these midterm election years, that can quickly get hit down there. We might not have a lot of time to reorganize our buy levels. We've got to be at the ready. Is that?
Yeah, that's right. Yeah. So I've sort of started a position, sort of some of those positions I'm down there at the, what I call my dream buy levels. So if they hit those just above those technical levels, and then I might start positioning a little bit as well here, just at some other levels in case it doesn't come down there. So at least I'm sort of if it really gets crunched, then I'm filling my boots up, over the top. And then, but if it's only a sort of a medium crunch there, at least I'm sort of, filling up half my boot, some positions as well. So it's just important to sort of try and, just get some positions here, into this weakness area, and just get to stick to the top tier. I think that's initially. So once the market gets a bit of confidence there, then we can start to, we can start to sort of progress to take a bit more risk on with a bit more growth there later on. So, yeah.
Very nice. Well, they're great insights. Thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.
And on the right-hand side, you can click on the link there to have a look at the full playlist of Gary's interviews. And then you can also click below to have a look at some of the trading strategies that Gary references in detail in his reports.